Welcome to Money Hangout. This is going to be a weekly feature. We have been talking to you directly uh, uh, through various other medium. I've been writing my columns. We have been reaching out to you, answering your questions on our website through television. Now through television programs, sometimes on radio as well. Now we are reaching out to you directly, and this is going to be a weekly dialogue with you. This has been made possible with by Birla Sun Life Mutual Fund. Every week we will pick up one subject which concerns you. We will talk about it in greater detail and how to deal with that situation which investors or savers face. And after that, we will be taking your questions. So feel free to ask your question. And welcome to this first edition of Money Hangout. And I will also be looking forward to your feedback to make this interaction more useful. And I look forward to as many questions as possible and how to make it more interactive. Today, our subject, as we have written to you, as you have registered, and that saving is not enough. Historically, we have thought that Indians save very intensely, and they are very conservative spender. Maybe that was in the past. That is not necessarily true as of now. Indians, of course, we know the way our parents saved, or we are a beneficiary of that. But my sense is that Indians are no longer the kind of saver that they used to be. Today we have, and why our parents used to save very intensely was, there were a variety of reasons. First, they did not have as much of spending avenues, and then they did the easy credit, the easy loan was not available. Things have changed quite dramatically. Today you can buy everything and anything at will, it in your neighborhood shop, and the online shopping experience or the opportunity or the facility, the supply of stuff available. So people used to, we have seen our parents waiting for their scooter, waiting for their car, and there could be many years of waiting before you could buy them. No longer so. Today, if you wish, you can buy it even if you don't have money, because easy, you can always take a loan. So taking your phone on EMI, taking your car on EMI, taking your TV on EMI, or taking your house on EMI, that actually defers your investment, because you are effectively mortgaging your future, your savings. You are mortgaging your future income. So it takes some time for people to get started. So that is one problem. But I think everybody should really start appreciating that what's going on, and it is how injurious it could be for you. So this is the first problem: overcoming the problem of not being able to invest or save in the first place. But once you have started saving, then there are a lot of psychological issues. First is that people think that they have to, and saving itself may not be enough. Once you start saving, then the money lies in your savings bank account. You think that you have to wait for that money to accumulate. It must be some meaningful amount before you start investing. Once you start doing that, then you make a fixed deposit, or you go for something which is a money back policy or some such thing, which will be a very low yielding, and you feel happy that something has happened. You don't understand what is going on. Also, the lack of appreciation of compounding. The early you start, the more the faster yeah, your money compounds. Even the small amount of money, most people think that your small savings in the initial stages, which is quite understandable, because in early stages of our career we earn less, and we have a lot of spend, essential spending itself consumes most of our earnings. So we end up with a very small surplus, and that small surplus looks so small that you think that nothing meaningful can happen. But it is extremely important, because the power of compounding, or the magic of compounding, that can happen on your small amount could be quite magical. And more so in your formative years, developing that belief that you have to be at it, because saving and investment is more a matter of habit. It has nothing to do with scale. There are a lot of wealthy, a lot of people who earn well, but they don't save, or they don't invest. And there are a lot of lowly people who are very disciplined about their savings and investments. So I think it's more a matter of attitude. It's more a matter of habit, and you should form that habit as early as possible. uh, all the procrastination, all the delays, and it's not an easy thing, because effectively what we are saying is that, if first, saving itself is that you are postponing your consumption for a future date, then investing has a lot of excuses, because most people think that you will get some opportunity, the market is too high. You come across all kind of jargon, or that, okay, I want to have my money handy. Maybe all these things, or all these reasons are realistic, or they could be a valid reason. But I think they mostly turn out to be an excuse, and this excuse is unlikely to help you, because the more you delay, the more it is a big opportunity loss. So I think it's very important for investors to appreciate that saving itself is hard, but you must save. Otherwise, you run the likelihood of your. And first, I would also like to give you context to this. We are going to earn well, and we are going to save, but if we don't really methodically compound our money, we run the great possibility because of outliving our savings if it is not if it is not earning optimum return. And today it is possible that I never in the past we had such avenues. Today it is possible to invest your small sum of money methodically, regularly, in a manner which will be very conducive to your savings behavior. You will not, and everything that we have seen in the past, that investors have been seasonal investors. They come in and in the market when the markets are very high, and they have generally been disappointed. In the last 2 decades, I have been closely tracking the market. I've seen that investors came in large number in 1992 only to lose money or get disappointed again in 1998, or as recently as 2008. And earlier, it was not possible to be very methodical with your equity investments. Today, it is possible. You can start with as low as 500 rupee. There are a lot of barriers that has a lot of mental blocks that people have, that it requires large sum of money and all those things. It's no longer so. Also, getting started has become easy, and there are very simple vehicles which will help you get on board. One is that today, if you have never invested in the market, you have never taken a market linked exposure through a mutual fund or anything, it is possible to do your eKYC. If you have your bank account and your Aadhaar, you don't have to visit anyone. You can go to any mutual fund company website or a Birla Finance mutual website and do your eKYC. That will enable you to get started. After that, if you have an online bank account, you don't have to go anywhere. You can get started. And I suggest that anybody who is hard pressed to even save must save a small amount to gain the full experience. So you must do it with your 500 rupee. You must do your SIP to just get a full circle experience of how to start and how to invest. And that will be a great beginning for most investors, because once you have done it, and you will be able to demystify things yourself. Because if I sit here and preach you that it is easy, it is not so difficult, you can do it, it's all fine, but unless until you step out and do things yourselves, you will not be able to really appreciate what I'm referring to. And it is important, and you will be doing a great favor to yourself. You'll be doing a great favor to your children. And this is not something which you can really procrastinate about, delay this, because we are going to live longer, and not having enough or outliving your savings is going to be one of the biggest risks that we will be facing in our lifetime. So thank you very much for your participation. I look forward to your question. Now let me check with Ashutosh if he has some questions.
Yes, Thiren, we've started getting a lot of questions from our viewers. Let me take the first one. Aditya, who is a retired person and his savings are primarily in bank FDs, is concerned about the decline in savings rates. He wants a return of at least 10% per annum, for which he would like you to recommend a few mutual funds to him.
Uh, Before that, I would just like to give him some principles that how should approach it, and maybe I don't have a solution. Just telling him a fund, recommending him a fund won't help. One is that if he has a capital, and 10% return on that capital will be enough today. He's destined for a very difficult time, because 5 years from now his need for income will be more than 10%, because inflation will go up. So even if we are able to ensure in some manner that he is able to generate 10%, he will fall short of, that 10% return will not be enough. So he has to really segregate his money. A good part of his money he should find its way into fixed income fund or guaranteed fixed income avenue investment alternatives, so that he's assured of a certain amount of money on which he can bank upon. And a certain part of money must find its way into market linked investment. By market linked investment, I mean a conservative equity fund, something like a balanced fund or something. So to begin with, he should think in terms of reducing his need for income in his initial years, so that he's able to allocate a part of his money to those investments, which will help him ensure protect the worth of his capital. Let me just elaborate on this point further. That assuming that you have something like 50 lakh rupees and you need 10% return, which means 5 lakh rupees a year, which will translate into something like, and somehow you are able to generate this, and which means about 42,000 rupees a month. Now, this will meet your needs today, but 2 3 years down the line, this 40,000 rupees will not be enough. The need, the 40,000 rupees will get changed, with inflation. That need will change to something like 50,000 rupees. That will require your capital to be something like 60 lakh rupees. So where do you get that 60 lakh rupees? You need that 60. For that purpose, you need to invest a part of your money in an investment, or make an investment which will grow at a faster rate than the rising inflation, so that you are able to replenish your capital. So you first and foremost reduce your income requirement, or lower your income expectation in your initial years, make an investment in something which is faster growth. That is the only way you will be able to protect the worth of your capital.
Thanks, Dhiren. The next question comes from Mr. Main Rai. He wants to know if index funds will give better returns than actively managed funds, given their low expense ratios.
Yes, index funds have lower expenses. They are capped at 1.5% by the regulator. But expense is one side of the story. But expense is not all. Simply because, we in India, the real performance, the performance matters. And if we have a compelling case for the actively managed fund, and there is a very strong case on a 10-year basis and on a 5-year basis. Most Indian actively managed funds beat the benchmark by a handsome margin. But most investors ask this question because the whole literature, the academic literature available in the developed market, that builds a very strong case, because even on a long-term basis, it is very hard to find a fund which beats the benchmark consistently. In India, that is not the case. More so, I don't see that the build-up of the case. I don't see in couple of years. Things might change after that, because the ability of a fund to beat the benchmark is entirely a function of how actively tracked or well researched the market is. If you have too many people bidding for prices, and fixing the uh, are, setting the prices of the stock every day, then it is very hard to find opportunities. In India, I think the lack of institutionalization, or the narrowness of the market, the breadth of the market is not very high. So I think, as the Indian markets gain maturity, it might get harder. But right now, I find that, based on the 10-year, 5-year, 15-year, 20-year performance of the actively managed fund, I think investors should avoid that. You should not consider an index fund, but consider a well-managed index fund, a well-managed equity fund, and they will get rewarded handsomely, and they are getting rewarded handsomely even now.
Sure. So Dhiren's view is clear on that. He thinks that the actively managed funds would continue to beat index funds in India for the foreseeable future. Moving on, Mr. Murali Krishna Reddy would like to know if it's safe to invest in PMS compared to mutual funds, and what sort of return he can expect there.
uh, he will get, PMS, or I don't really hold a very high opinion of a large number of PMS, but there are some very fairly impressive PMS, but there is a big difference. One is that you need 25 lakh rupees to, that's the minimum ticket size to start your PMS account. That is the regulatory requirement. That is the regulatory mandated requirement for that the investment minimum. That's one. The other is that, mutual funds are regulated very intensely. Third clear advantage for mutual fund is that when you invest in a mutual fund, the fund manager might be buying, selling something in the portfolio, and that will be treated as long-term capital gains as long as you hold your mutual fund for more than 1 year. So whatever, irrespective of whatever the fund manager is doing, your money becomes, your investment is treated as long-term capital gains if it's held for 1 year. But that is not the case in case of PMS. The PMS manager, if he's buying and selling more often, all your gains can well become short-term capital gains. Uh, Fourth point is the transparency. Mutual funds are very tightly regulated, and PMS is not so tightly regulated. I would rather say loosely regulated, because that is a contract between you and your portfolio manager. You are effectively giving a power of attorney and the money for somebody to invest on your behalf. And he is an interested party in a sense that, of course, he is a beneficiary. If you do well, he will make more money. But then your information is supposed to remain confidential. When it comes to mutual fund, they are supposed to disclose their portfolio. They are supposed to comply with all the regulations. They are also supposed to, yeah, comply with all the guidelines, which I think brings about a greater, you know, uh, greater safety of your investment. At the same time, I think, when it comes to managing money, I think mutual fund companies who are also running their PMS scheme will be deploying greater resources to managing the mutual fund, simply because they have the economies of scale. When you have a 5,000 crore fund, where the fund company will be willing to dedicate a team of analysts and other people. So I think, given the transparency, disclosure, tax efficiency, and all the things that I have listed below, the choice is very clear. And that apart, the low ticket size, with your 1,000 rupee every month, which you can actually invest and be transparent about it. And given the, all the things that I mentioned about before, I think the choice is very clear. Mutual fund is a great deal in India even now.
Sure. Moving on, Magesh would like to know why debt funds have capital gains tax but not equity funds. And further, he asks how can he minimize or avoid incurring capital gains tax, Thiren?
No, there is no way to avoid incurring it. It amounts to tax avoidance, and that is, that is illegal. But yes, I'll just give the premise of, why it is treated as capital gains. Uh, in fact, and the rules recently changed. A couple of years back, we had a big change in the way, uh, the taxation of fixed income funds used to be. Earlier, if you held a bond fund or a fixed income fund or a debt fund for over 1 year, it used to be treated as capital gains, and now you have to hold it for 3 years. Why it is treated as capital gains? I think, uh, it is still preferential, in a sense that the nature of the return that you derive from a debt fund is that of fixed income. And when you derive the fixed return from any fixed income alternative, whether it be post office small savings investment or a NSC or a PPA, not PPA, but NSC, or any bond or any bank deposit, then the interest that you earn is completely taxable. It is added to your income and you are taxed at your marginal rate. As compared to that, when you invest in a mutual fund, your appreciation, which is the nature of the underlying nature of that, is of fixed income. It is, it is the equivalent of an interest, but it is treated as capital gains if you hold it for 3 years, and any period before that, any period less than 3 years is added to your income. So this is to bring about the parity in the character of the income that you're deriving. Being treated as capital gains is attractive. It is actually favorable for you. Though my sense is that, principally speaking, it should be treated as exactly as the way your interest income should be treated.
Okay, thanks for advice, Thiren. Next up, Gopal, who is 34 years old and is able to invest about rupees 40,000 a month in SIPs. Uh, he wants to retire in 15 years and he would like to know how many funds he should invest in and how should he allocate his money between small, mid, multi, and large cap funds.
First is that, there isn't a thumb rule. You don't have, but I actually, like to give the guide, the principles which one should generally follow. If you are looking at, which kind of fund you should be investing in, whether it be small cap or large cap or a mid cap, then it is very hard to keep track of it. And it is very difficult to not get distracted, because some funds will be doing exceptionally well at a certain point, and some funds will be might be disappointing at times. And you will be tempted to act, which is generally counterproductive. So I would say that having 3 4 multi-cap funds, these are the kind of funds which will invest in large cap, mid cap, and small cap stocks as well. The fund manager will keep track, change track depending on the situation or the circumstances. It will have the necessary flexibility, but it will be broadly diversified. And when you are 34-year-old, and when you are going to invest for next 20 25 years, I don't think being very tactical helps. If you are methodical about it, so I would say that choosing 3 4 multi-cap fund will be enough. Having one or two small cap fund just in case you want to really supplement your portfolio, but you can well do without that. If you are investing for the first time, I would say that first 2 3 years start with 2 3 balance fund, so that you develop a belief. But more importantly, I think the one single factor which will, one or two things which will bring about a huge difference in your overall net worth when you retire is how effective, how disciplined you have been. If you keep investing these 40,000 rupees every year, and then you are able to increase your contribution. If your income goes up by 10%, you should be increasing your 40,000 rupee to 44,000 rupee. If you are able to step up your investment with your rising income, and if you are disciplined over the next 30, as you are 34-year-old for next 26 years, I can visualize that you will be a real wealthy person. And keeping it simple, 3 4 multi-cap fund, and maybe doing a review every 3 4 years is a simple plan you should follow.
Thank you, Mr. Gopal. I hope you've noted the advice Serene has given to you regarding the choice of funds as well as the way to go about it. Uh, this is an interesting one, Dhiren. Kisan has a view, and he says that how would a rupee 500 investor be able to find either an investment advisor or a mutual fund distributor beyond the top 15 cities if SEBI's proposed regulations, which have been put out, were to come into effect?
uh, a 500 rupee investor is unlikely to get any help. And but my worry is that even now a 500 rupee investor, as SIP investor, is likely to be remain underserved even now, despite all the variables. So I would say that a 500 rupee investor should think about, or seriously work towards helping himself. And yes, these are times I don't know what SEBI regulations will eventually evolve and how things will change, but things are changing over time. And I think despite the changes, good advisors have become bigger. The investment, the scale of investment being made into mutual fund has grown, and investors have benefited. So yes, these are times of big changes. There are disruptive changes, which is primarily enabled by technology and the kind of things which are possible today, which was not possible earlier. So we will be in for some uncertain times, but the smallest guy is going to get underserved, will never be very efficiently served, and there just will not be economics there. A 500 rupee investor will translate into a 6,000 rupee annual investment, which will translate into a revenue stream even now, given that the revenue possible will be so small that I don't think it will make economic sense. So he needs to take care of himself, and today it is possible to be served himself.
Great. Next up, we have a question from Ashish, who is an NRI, and currently he has a large part of his savings in NRE fixed deposits, along with some equity mutual funds. Now
Mhm.
he's considering to shift his money from his NRE fixed deposits to debt funds, given the decline in interest rates, and he has a time horizon of 10 to 15 years. What do you suggest?
Yes, if he's thinking in terms of keeping, if he wants to have long-term investment into fixed income, long-term fixed income investment, then I don't have any suggestion. But I think it is unwise, it is not prudent, and more so for an NRI who will have understanding of India. And I think next decade, or decade and a half could be, uh, uh, one has great reasons to be very optimistic about investments in India. We are a bright spot and we are likely to remain so. And there are very fundamental shifts or changes happening, which will translate into hopefully, a great investment performance as well. So long-term fixed income investment, I don't see a reason unless he has something specific to him that he must keep all his money into deposits or fixed income funds. And if he's working towards a plan, I think he should consider moving a good part of his money, long-term money, into equity. Short-term money and the emergency fund or any targeted financial goal in the next 2 3 years should definitely be in fixed income fund. And next 2 3 years, I'm very optimistic that the kind of rate cut that we should visualize, which I visualize, will translate into something one time. Of course, it is going to be a one-off thing, but it should translate into a very decent return, 8 9 10% kind of return from fixed income funds as well.
Sure. In fact, the fall in interest rates appears to be one of the recurring themes in the kind of questions that we've been getting, Dhiren, from our viewers.
Mhm.
And probably this is the time when all fixed income investors should be seriously reconsidering adding a component of equity to their portfolios.
That is actually the problem, because most India is a country of fixed income investors. For historical reasons, we think that that is a default investment that we have to make, and we have a system. We have a culture, which is I'll just explain what has contributed to this culture. uh, when somebody starts his job in the organized sector or with the government. With the government, your contribution used to go towards the provident fund, which will earn you fixed income. So the longest term investment earns fixed income. When you join the private sector, your money goes into provident fund, employee provident fund, which was dominantly fixed income, and the returns are announced every year with great fanfare. So we believe that and you look at the discretionary saving that finds its way into today we have the mutual fund industry has grown. A lot of investors are investing in mutual fund, but it is nothing as compared to what is the scale of investment that is methodically going into public provident fund, which is a fixed income alternative. So investors in India are fixed income investors for some historical reason. We did not have market which was accessible to investors in general. Mutual funds were not popular for even now I would say that mutual funds are not popular. Only 2 crore people have invested in mutual fund altogether over time, so which is hardly a number given the scale of our country, given the population. So I would say that India is a fixed income country, and decline in interest rate will leave a lot of investors, lot of individuals in great difficulty, because we are used to once interest rates come down and inflation also, and with that the inflation is coming down, but the real inflation of an individual is very different from the inflation number which government puts out, because our inflation is the cost of rising healthcare, or the cost of rising health, or old age, old age help that you will require in your old age. So that these are the kind of things which will not be reflected in the consumer price index or wholesale price index. But interest rates will come down. Historically, Indian investors don't have this feeling of have earning low return, simply because the interest rate was the inflation was so high, that if the inflation was 10%, and if you're earning 10% or 10.5% on your deposit, the 10.5% absolute return on your deposit made you think that you are earning enough or well enough, even though you are actually losing money. Now, once that return comes down to 4 or 5%, the way the RBI has gone about targeting inflation is coming down by their yardstick, and so interest rates will come down. And once you realize that only your saving is earning only 5%, you need to do something very urgently. You run the great risk of outliving your savings or eating your capital, because once that happens, you will have to dip your hand in the capital. Once you dip your hand in the capital, then you don't know at what pace you will consume it. So despite having worked hard to save the capital or the money, which will take care of which you should take care of you in your old age, you will suddenly realize that you are dipping into that, and it takes very little time to deplete. The deep decompounding of the also just as alarming as the way we see the magic of compounding. So investors need to really worry about this, do something proactively about it, do it in a calibrated manner so that you are not taking the unusual risk of catching a market high in your zeal to optimize return. Don't try to perfectly time it, and you need to methodically plan this. Otherwise, despite having the capital, despite having the money, you run the possibility of consuming all of it and then staring at a blank bank account.
All right. Next up, this is a very, very interesting question and, in fact, a timely one. Sanjay wants to know why MFs don't allow people to gift each other units on occasions such as Diwali.
Primarily because of legal reasons. For gifting anything, financial products require KYC, which means the person on whose name somebody is one is investing, his credentials must be validated, and these are done with and there is a norm specified by the Money Laundering Act. So before that, it was possible. In fact, not very long back, about 8-10 years back, to Birla Sun Life, then it was only Birla Mutual Fund started a gift voucher for mutual funds. So if you gifted somebody 1,000 rupee worth of that voucher, he can buy any of the fund. That might be possible even now, but uh, the person still has to go through the KYC norms. And if you are already KYC, if the mutual fund companies have known that you are an investor whose PAN or by your address is validated, and you have been an investor and you have been authenticated, it should be possible. But yes, earlier it used to be. There must be some operational glitch holding it.
All right. Next up, Anshuman wants to know if the size of the fund matters, especially in case of small cap funds, if the AUM is large. And further on, he would also need your advice on some good small cap fund.
Uh, I would like to, point him that yes, in small cap fund, it matters, size matters, and I would say that I'd just like to explain why it matters, because uh, a small cap fund is think of a small cap fund which is 300, 400, or 500 crore fund, and if you have to be well diversified, and given the scale of the lack of the lack of liquidity in the underlying investment, when you are buying a small company stock, it may not be very liquid. And if the fund turns big, then the fund necessarily has to find newer ideas. And finding 20 idea is one thing, finding 50 idea is one another thing, and finding 200 ideas in Indian market of in case of with a small cap universe might be extremely difficult. So size definitely is a barrier for a small cap fund. It matters. Once a fund turns big, lower your expectations. And I think many fund companies will also consider stopping to take they will close the fund for new money, because it will also become difficult for them to demonstrate their performance or manage it efficiently. uh, I would I would say that he should try. This may not be a great time, because what we have seen, that the small cap and the mid cap fund have done exceedingly well. They look pretty expensive, and they could have done very well for another reason. That large caps, or the big companies in India, if you look at the broad sectors, the metals were out of favor, the technology companies are struggling, and the banking sector was struggling. Once they are active, if they regain their momentum, if they are able to regain their earnings momentum, or if they start doing well again, then I think small caps, mid caps, they are very niche stories. You need to really consider a fund based on how it has gone about achieving the return, rather than looking at the absolute returns. Many investors are getting tempted to ride this momentum. Investors chase recent past performance, and I think at this point it might be simply dangerous or very risky to do that. And look at our small cap universe. Your anybody's starting point should be somewhere, the top rated universe, a 4 and 5 star fund of the small cap funds.
Thank you, Dhiren. Next up, again, something which perhaps a lot of investors have a keen interest in. Dave wants to know the merits and demerits of sovereign gold bonds.
Uh, Demerit is that you are effectively buying gold, and all other and once you have decided to buy gold, then I think there are only merits, because if you put gold in your locker, it will not earn anything. The sovereign gold bond actually earns some interest. Uh, Besides that, I think the safety is absolutely as gold, because it is a government of India promising you to give you the price of gold appreciation or depreciation. Uh, there is absolutely no disadvantage in holding this bond, because there will be no making charges or no risk of impurity. Uh, so all these things are pluses. The other advantage is that you will be exempt. If the original buyer holds it till maturity, then he will also be exempt from it will be treated as capital gains, which is also an advantage. Uh, it will be exempt from capital gains. The only disadvantage to my mind is that gold is not a great long-term investment vehicle. Gold has done well for a variety of reasons. It can still do well. There is a whole hypothesis that the kind of the way countries are printing currencies and the fiat currency that we see all over, gold is bound to get traction, and gold is bound to appreciate. It is a store of value. But I think there is much more to it. There are other issues. Uh, Gold doesn't produce anything. It does not produce an income. It is entirely dependent on more people buying gold over a period of time, and being an unproductive asset. And I think what led to the great bull run in gold 5 7 years back was the financialization, or the 2008 global financial crisis, where people rushed to anything which was safe, or where they can, when bonds as well as equity struggled globally. So that was a big problem that actually led to the charm of gold in an uncertain times. But if you are optimistic about the future, if we are going to have a better world in 5 years, 10 years, 15 years time, then one should not be holding gold. One should look at gold. The other disadvantage of gold is that you can't really show off. You really can't wear it, and you can't really tell people that you have gold.
Great. I think that that last reason is quite compelling enough, isn't it? Okay. Moving on, Dhiren, Mr. Shukla is a senior citizen, and he would want to know what is the right time to invest in a mutual fund.
uh, I'm going to give you the best answer of this hangout session, which is every day is a good day to start your investing. If you haven't done so far, you have missed out on a huge opportunity. If you don't do it today, you will regret it for a long time. And because, and most important thing is that most people end up waiting for too long, because markets are by design, are they will either scare you. If the markets are crumbling, if the market is falling freely, you will be too scared to invest. And if the market has gone up, then you will be waiting for it to correct, because then you will be fearful that the market will correct, and you will never get an opportunity to get in. So the best time to invest is, be methodical about it. Invest. If at all you want to calibrate, then devise your own formula, devise your own method, that a P of certain thing you will invest more, a P of more than this you will invest less. But don't discontinue investing, because if you try to perfectly time it, you will be out of the market. Your money will remain idle, and you will never be able to benefit from this great thing created, which is democratizing public participation in ownership of companies in the country, which is the only way to beat inflation and get wealthy.
And I think lost time has a tremendous opportunity cost, isn't it?
Absolutely. If you look at if you look at a lot of people who discontinued their SIPs after 2008, uh, many investors came, they were disappointed, the market crumbled, and rightly so, understandably so. But if anybody would have done, but since 2008 to 2016, when I look at the SIP return, the ups and downs of the market actually creates a huge opportunity. In fact, creates a great advantage for the individual investor who is disciplined. As Buffett said once, that the rewards of uh, patience and the rewards of the perils of impatience that we can see here. Most people, even if they would have started at the peak of 2008, would have started methodically investing in this market. One would have generated a return of, it will be upwards of 20% more than what Sensex has returned since then, simply because you bought at highs and lows as well. And you would have generated twice as much return as compared to fixed income return available during this period, which I think is a phenomenal return.
Okay. Next up, Prathamesh wants to know if the stability of large cap or balanced funds vis-a-vis the diversified equity funds is overrated. His reasoning is that during a market correction, even those funds fall by almost the same amount.
No, it is not overrated. Maybe if you are a venturesome investor, you might think that it is overrated. But there are people, let me just give you the real numbers. If you invested in a balanced fund and 2008 happened, it went down by about 40%. The large caps went down by about 55 to 60%. And there were many small cap funds which went down in value by 80%. I'm not saying that 40% decline in value and I'm talking of 2008. 2008 is a once in a maybe 50-year phenomenon. I don't know how long it will take for us to experience another 2008, but I'm talking of the worst of times in the market. And so the asset allocation matters. It helps. If you are a 60-year-old or 65-year-old person, and if you had invested in a balanced fund, you would not have you will have problem, but you will not have that kind of problem that will happen if you invested in a small cap fund which went down by 80%. Your 100 rupee became 20 rupee. Of course, that 20 rupee also recovered to 100, and the balance fund also recovered over time. But it takes, and so if it is entirely, it is a function of two things. How much time do you have for your investments to grow? If you are in retirement and if you plan to derive income out of it, or if you want to do some periodic withdrawal, it is not overrated. It is meant for those people. In fact, most of us forget what risk is in good times. But risk is meant to be, you have to be conscious of risk only for the worst of times. And that we are fortunate that, and the other thing which we should be very aware of, that when it comes to a market fall, it happens way too quickly and the rise are very gradual. So most of the times we are not in a frame of mind to appreciate risk. And those are the times, and it happens once in a while. But it is actually a test of your tolerance. It is a test of your discipline, or how much can you endure that. And that I think is important for a person to broadly. It is very difficult to measure what is my risk tolerance, but going by two things can determine that. One is that how much time do you have? When are you likely to need your money? And the other is how long you have been in the market. If you are a person who has been through the market even through 2008, you will be very easily able to appreciate what market is all about, how confident you can be of a bounce back or a recovery. But if you came in the market last year and you are witnessing a 40% return on your investment in just 1 year, you will not be able to appreciate. You will get out of the market very quickly, and that I think is a problem. So it's very important for investors to get started with the right kind of vehicle, and only after you have spent some time that you will be able to appreciate the risk as well as the rewards.
Moving on, Yashwant wants to know that he has a house in Pune in which he's not staying and he's not sure about the future as well. He says that it's priced at about 1 crore and he can only get a rental yield of a rent of 15,000 a month on it. Now he's asking, should he be selling it and investing that money in mutual funds or equities and buy a house at a later date when he's sure about where he would want to get settled?
Uh, it may not be a bad idea, but I think you should work towards that plan. I don't. It's very difficult to visualize, but this is the situation across the country. The rental yield on homes, it clearly refers to two things. One is that either houses are overpriced, but we haven't seen any situation in India where house price is correct. There are a variety of reasons. Many a times investors, or the the people who own these houses or the people who are buying these houses today, sometimes they invest a lot of money which is unaccounted, so they don't really look at the opportunity loss. If he would have bought this house for 1 crore, and if he is paying his EMI, then clearly, one can understand that uh, it is it is clearly a bad transaction, something on which you are incurring a cost of 9 to 10% or maybe even 10.5% interest, and your rental yield is 2%, and I'm not very sure about the potential appreciation. But houses, residential houses, they are very low on rental yields, but they can well appreciate. But the appreciation form could be different. So I would say that is entirely a matter of how there is one more problem when you think in terms of liquidating this selling this house, getting the money. There is a reasonable possibility that he may not get all the money in by way of check, which is investable, which creates a different kind of problem. But yes, I would say that if he is very unsure of living in this house in the foreseeable future, it will be worthwhile to invest your money. But there are different ways of investing. He should not be selling his house and investing all the money at one go. He should definitely plan this investment staggered over a period of time, 1.5 years, or maybe 3 years, because catching a market high with such a lump sum amount might prove to be very, disappointing and unnerving too.
Next up, Bhavesh wants to know if you can recommend a few good books about investing opportunities in India and the basics of economics. Any top of the mind recalls, Dhiren, for him?
No, read the newspapers, and I think we have plenty of media around. I haven't come across too many interesting books written about in India about the Indian market, which explains the things. Recently, I've come across a lot of investment books in India of late, which are interesting. But the kind of content he's looking at in a book, I'm finding it hard to recommend one.
All right. Moving on, we have a query from Senthil. He started investing in 2009, and over a period of time, the number of funds in his portfolio has increased to 12. And he says that they are somewhat of a similar kind. And he wants to know how can he deal with such a situation.
Uh, I think he should put his portfolio in our portfolio tracker. Look at how his portfolio looks like when he is able to aggregate all his investments together. When he is able to put all his investments in Value Research Portfolio Manager, then he should go to the analysis tab, and he will get a sense of how his money is spread. 12 is not too many, because I have come across instances where investors have 15, 20, 25, 30, sometimes even 50 funds. If these, but I think it will be more manageable. He should look at the split. Many a times the count might be 12, but 80% of this money might be lying in four funds. Two, three principles to be followed. My understanding is that four, five, or six funds at most may be good enough for your long-term portfolio. It should be as simple a portfolio as possible, as I was saying in the initial question, that generally speaking, one should have a multi-cap fund, and that as a core of your portfolio, so that it requires less of a manageability. Then it becomes a low maintenance thing. The moment you buy a small cap or a mid cap or a large cap, then you have to intervene more periodically, more often. Then comes, you should be diversified in a manner, also by way of style. All your money should not be invested in a single fund company's portfolio. I have come across situation when somebody buys a balanced fund as well as a large cap fund as well as a multi-cap fund managed by the same fund manager, with great, a good part of the portfolio being common. That is avoided. So you should try and achieve diversification very meaningfully, which means different managers are managing your money. Your portfolio individually are always diversified. Your individual portfolio on a consolidated basis is well diversified. And putting your portfolio in Value Research Portfolio Manager and looking at the analysis tab will help you.
All right. Moving on, Kantavel wants to know if investing during a market correction is a better strategy than SIPs.
If at all you can visualize or actually guess that market correction has started, and market correction will continue till what time period. If you can do that, uh, absolutely, but it's very difficult. I would say that it's not only difficult, it is impossible to do that uh, temperamentally as well as guessing it. Because when the markets are crumbling, it psychologically it is a very difficult thing. Because today, if you invest 5,000, if you invest a lakh of rupees, and tomorrow the market is, because when the market is falling, it is falling in a brief period of time very rapidly, and so next day it becomes extremely difficult to invest again, because now you see your yesterday's investment going down in value. That is why I suggest that uh, be methodical about a substantial part of your savings, and try and be tactical in a very minimal way, because there is another disadvantage. If you somehow succeed, which I think will be an accident, or it will be an act of God which will help you do this, uh, then you will think that you can do it often and you will go wrong as well. I haven't come across any fund manager who has done it right, in terms of calling the market that the crash has happened. And if you are trying to do this, if you are waiting for the correction, let me give you one more example. If some investor expected that markets will correct, investors were investing, waiting for the correction, or sometimes bailed themselves out from the market or from mutual fund investments. When the market started moving up in 2004, it went up from 4,000 to 5,000. A lot of investors pulled out. Then it went up from 5,000 to 6,000, 7,000. At every stage, investors were getting out of the market, and the older ones who had gone out of the market were getting in again. And then we saw that the market moved in a very steady rise, went up to 20,000, and investors never got an opportunity for a bid, and they kept waiting for the big correction. And when the big correction happened, and then they lost patience and they invested at the peak or close to the peak in 2006 and 7. And after that, the big correction happened, and when they pulled out. So I would say that get out of this whole mechanism. You are investing your lifetime savings in a methodical way to benefit from equity, and you should invest in a manner that a big rise in a brief period or a big fall in a brief period, it should not affect you. And if at all you try and do this, do create a fund allocation, create a fund of yourself, for yourself, of 1 lakh rupee, which you think, which will, if you try and time it, see if you are successful, and even if you fail, it will not derail your overall financial plan. Call it a fund allocation and be at it. Because if you do it with your core savings and try and time it, there is a great risk that you will have this big opportunity loss and great regret.
Indeed, fund allocation aside, it has been a long-standing advice from Dhiren that always choose SIPs over trying to time the market. Moving on, Dhiren, Ravi would like to know that if a 90% equity allocation is acceptable for a time horizon of about 20 to 25 years, and further on, he wants to know when is it a good time to exit non-performing funds, particularly taking into account value research ratings.
Uh, I would say that don't bank on the rating heavily, but I would say sustained underperformance, which translates into consistent decline on the ratings for 2 years and more, will clearly be a sell call, because there is also a possibility that lot of short term performance combines to actually make it long term. And I would say that 2.5 years is a good enough period for somebody to review his portfolio and make changes. And if a fund has been consistently below average, that will translate into lower rating of 3 star and below. Uh, and that should prompt me to really consider my investments there. And 90% allocation to equity for a 25-year term, absolutely. But at the same time, do a annual rebalancing, because assuming that the market is going up and your 10% allocation to fixed income, rebalancing is crucial. 90%, absolutely no problem. But if that 10% actually becomes a sizable absolute number, assuming that today your portfolio is worth 10 lakh rupees, and with steady rise in your contribution as well as appreciation of your equity investment, your 90% actually becomes 95%. it will make sense. And I would imagine that your 10 lakh rupee, once it becomes 1 crore and your fixed income allocation becomes 10 lakhs, that will not happen if you are not rebalancing. So do your annual rebalancing. That will ensure that a part of it is moving to relatively safer positions, or which is insulated from the market. And absolutely, I would say 90% is aggressive but worthwhile.
Thanks for that, Dhiren. Next up, Nirmal would like to know how the different categories of debt funds are different. So he's mentioned these various categories where he wants to create a distinction between. He's talking about gilt funds, short-term debt funds, long-term debt funds, MIPs, and liquid funds. And further on, he wants to know for a 2-year horizon and a corpus of 2 lakh, which of these would you recommend?
There are a lot of these fixed income funds are meant for very specific objective, and it can actually be uh, mapped to investors' need. For example, if you have money for a few days, consider the liquid fund. Money for a few weeks and months, I would say consider the money for a few days, I would say ultra short-term bond fund and the liquid funds. Money for a few weeks and months, consider the short-term bond fund. Money for a year and more, but you don't want to take chances, or you want no volatility, or low volatility, and low risk of losing your principal, then consider the income fund. Then optimizing return on your fixed income, consider MIP, because these MIPs are nothing but uh, 10 to 15% into equity, which will help you beat inflation. But then that is a long-term investment vehicle. If you're a very risk-averse investor but want to protect the worth of your capital, consider MIP. The rest of the things are very peripheral. I would say that they are not mainstream fund. Guild funds invest only in government securities, so they are free from the possibility of any default in the portfolio. But they can go up and down. The value can go substantially up and down. They are meant to be a vehicle where investors invest in gilt funds when they expect that the interest rates will come down, because gilts are able to long-term bonds are available only from the government. We don't have too many long-term uh, bonds issued by the private companies or the corporate bonds. So they reflect the change in the interest rate outlook very quickly. So consider that if you are trying to actively, but it is not meant for individual investors. Likewise, short-term gilt funds. The other vehicle, and of late, many income funds are also being called dynamic bond fund. That is the kind of fund which is where the fund manager is supposed to move your money very actively. So if you are looking for an investment vehicle of a medium term, 3 to 5 years time frame, and trying to optimize your return, and you are a risk averse investor, consider the options from income and dynamic bond fund. Few days and few months, you have very clear choice. Investing for 2 years, as I said, consider short term bond fund. You should be able to beat the return that you will derive from bank deposit, but you will not get the distinct tax advantage that you have on these bond funds, because the bond funds become very tax efficient if you hold them for 3 years and more, because the ability to convert your income into capital gains, otherwise all your gains from these bond funds for holding of less than 3 years is added to your income, which is not greatly advantageous.
Thanks, Hiren.
Thank
Uh,
you.
Probably we have time for just one last question before we wind up the session for today. This one comes from Vikas, and probably a concern many first-time investors may have. So this could be a good time to address this, Dhiren. He wants to know what could be the extreme reasons under which a person can lose all of his mutual fund investment value, or if that's possible at all.
Uh, I haven't come across any such situation in the last 25 years, ever since I've been tracking mutual fund. But there have been some instances uh, uh, in the world, but no such is a situation where investors have lost all their money. There are other investment avenues, reset, and generally where you lose all your money is a case situation when you have an equity portfolio, or you are getting into some exotic investment option. Bernie Madoff, after 2008 was a situation where he took the money and he was running a Ponzi scheme, or he was just, running a shell scheme. He just took investors' money and people trusted him. I don't visualize that situation in mutual fund the way they are regulated, and I haven't come across any such situation. There have been situations where mutual fund companies have the market has stumbled, as I was telling you. There have been two such instances. The technology funds at their worst of times lost 70-80% of the money, and that was and then they recovered as well over a period of time. Likewise, the small cap funds and the infrastructure funds lost substantial amount of money. If you invested a lakh of rupees, the worst ones were actually down 60-70%, but then they also recovered over time. It wasn't a case of downright fraud, unless we come across a situation that a downright fraud which has been reasonably uh, uh, I haven't come across any such situation. It can also happen if you own stocks directly, and if you are running a very concentrated portfolio. There is a possibility, because we have a lot of stocks which can stop trading, the companies which can wind up. And if you have been able to build a portfolio of chosen stocks which somehow close down, then you can lose money. But I haven't come across a situation in mutual fund so far.
That's all we had time for in today's session. Any parting advice for our viewers, Dhiren?
Yes, we are on the Diwali Eve, and be a little careful with your spending. Try and hold your and consider, saving is not enough. Saving is not enough, and maybe this Diwali it could be a great gift to yourself. Saving is not enough, and investing is very important. And if you do that, you will have a lot of happy Diwali.
Thank you, Dhiren. Thank you, everyone, for joining in. We will now close the session.
Thank you.